Hey there, everyone. My name is Saeed Hamoud. I am a licensed loan officer and I consider myself a first-time homebuyer specialist. So, in this class, you're going to be learning about how to purchase your first home, whether you're a beginner or you bought a home in the past and you're just getting back into the home buying process. Things have changed quite a bit. If you bought a home maybe 10 years ago, now you're getting right back into it. Guidelines have shifted somewhat. Programs have relatively stayed the same, but nonetheless, you're going to get everything that you need to know from start to finish. We're going to talk about guidelines, programs, what appraisals means, what home inspections mean. We're going to talk about contingencies, who your team is. We're going to go through all of those things and maybe a little bit of budgeting and how credit works. So, Home Buying 101, let's get started. All right, everybody, if you're thinking about buying your first home, you have made it to the right place. This is Home Buying 101. We're going to get into a video series that's going to take you from A to Z on how to buy your first home. If you're an absolute beginner, you want to stick around for this video series. All right, let's get into it. So, my name is Saeed Hamoud. I'm a licensed loan officer with Cross Country Mortgage. I've been a licensed loan officer for 3 years. I'm licensed in California, Texas, and Washington. So if you have any friends or family looking to purchase a home, definitely reach out to me. I'd be happy to help you or your friends or family members. So, let's get into it. If you have questions, please leave them down in the comments. I will get back to them as soon as I can, and I hopefully will be able to get back to everybody. So for the agenda, we're going to talk about renting versus owning, the bonus to buying. We're going to assess and plan. We're going to do some mental and emotional gymnastics. We're going to talk about financially what it looks like to buy a home. We're going to talk about the home buyer roadmap, and then we're going to open it up for some Q&As. Obviously, you're not doing this live, so leave them down in the comments like I shared. Okay, so let's first talk about rent versus buying. What is the bonus to buying a home? You're going to get tax benefits. You're going to be able to build wealth and equity. Can't do that when you're renting. You're going to have some pride. You know, when I bought my first home, it was amazing knowing that I could actually call something mine. It was my home when I purchased my first home. You have the ability to have that stability with your family. You know, now you get to have a roof over your head that you can call yours. You're literally building equity every time you make your payment. You're not just making a payment to somebody else and paying somebody else's mortgage, because that's literally what you're doing if you have a rental right now. So if you're living in a home and you're renting, someone has a mortgage on it and it's not you. So that means you're paying your landlord's mortgage. So why don't you just pay your own mortgage? That's what I say to all my clients. It's yours. So mentally and emotionally, let's talk about that. Financially, assess the plan. So the earlier you can actually sit down with a mortgage professional, the more success you can ensure when it's time to make an actual offer. So I'm a licensed loan officer, and I talk with people every single day about what they need to do to prepare themselves, both mentally, emotionally, and financially, to be prepared. And I'm going to tell you what, buying a house is a process. It's definitely not something that you want to just walk into one day. You can't just go to like a Walmart and buy a house. You have to prepare. You have to prepare financially. You have to save some money for your down payment, for those closing costs. You have to have the ability to maybe have some delayed gratification, so you're not spending money on credit cards and racking up credit card debt and ruining your credit or lowering your credit, because those all matter when it comes to buying a house. The better your financial report card, the better you're going to have, the better chances you're going to be able to buy a house when it comes time to buying a house, right? So those mental and emotional, hurdles that people need to get through 6 months to maybe to a year prior to buying a house, those are what you're going to want to focus on if you're trying to buy a house for the first time. Okay. And then, of course, assess and plan. You're going to have to, understand, after speaking with the loan officer, what does it mean to buy a house? So is there a down payment going to be required? Is there going to be closing costs going to be required? Is there things you have to do to your credit that are going to be required? Those are all very important things that you need to speak with the licensed loan officer to get that plan in front of you. Okay. So let's go on the next step here. But mentally and emotionally, what's your why? Why do you want to purchase a home? Maybe you don't want to spend more money on rent. Maybe you're growing a family. Maybe you're having a kid. Maybe you are moving to a new location. Maybe you have plans to move to a new state and you actually want to buy because it's cheaper there or something. Maybe you're looking to build equity and start building your portfolio. Maybe you want to purchase on your own, or you want to go in home purchase with a friend or family member. And then you also have to ask yourself, how much work would you be willing to put into your home? So are you looking to buy a fixer-upper? If you're looking to buy a fixer-upper, sure, you might get a discount on the house, but you're going to have to put that sweat equity into it. Or do you want something that's move-in ready? Those are all questions you're going to want to ask yourself prior to going into the home purchase process, okay? Financially. So I want you to think like a lender here. The reason why I want you to think like a lender is because we lenders only lend money to people who are financially responsible. So the higher the credit score, the better rates and greater options you'll have, okay? You want to talk about your monthly survival number. If you watch any financial channels on YouTube, the monthly survival number is just like your emergency fund. Dave Ramsey, he's a big proponent of the emergency fund. I love an emergency fund. I like to have 6 months in the bank, 12 months if you have a family. I would recommend prior to going into a home purchase, you don't put the whole, kitchen sink into your home. You don't go, for lack of a better term, you don't go balls to the wall and put all of your savings and, monthly, income into your mortgage payment into your house. I don't think that's financially responsible. I don't think that's financially responsible at all, because what if you move into that house, you spent all of your savings into that home, you barely have enough money left over at the end of the month for groceries? What good is it buying a house? You just bought yourself, a financial burden now, so having at least 6 to 12 months in the bank for your monthly survivor number, I think is prudent investing. It's something that everyone should do, whether they own a home or not, because you should have aspirations to buy a home. So why not just have that fallback money just in case something was to happen? Maybe you lose a job, car breaks down, whatever it is, you want that. After putting aside 6 to 12 months of your monthly survivor number, how much can you put towards the down payment? So that's where savings comes in. Do you have a savings? Do you have $10,000? Do you have $5,000? How much do you actually have that you're not going to break the bank after that 6 to 12 months has been put away? You're going to want to know how much you have and how much you're working with considered liquid. That way, when you go to your loan officer, you can say, hey, I have $10,000, I have $20,000 I want to put towards my down payment on the house, okay? Next thing is income. Do you have a consistent earning history? So myself, as a loan officer, when you do an application and you're wanting to get pre-approved for a home purchase, we're going to look at least, I'm going to first look at it, and then my underwriter is going to look at it. I'm like the lawyer, my underwriter is like the judge, right? So I have to make a good case as to why we should give you $500,000, $300,000, right, to buy your house. So I'm going to see, based on your work history, things like W-2s and pay stubs. Have you been working consistently for the last 2 years? And that can be multiple jobs. It doesn't have to be all one job. Most people think they just have to work one job for the last 2 years. That's false. You need 2 years of consistent work history, okay? Consistent work history, meaning if you have, let's say, a restaurant job 1 year and then you have a sales job the next year, were you getting paid W-2? Answer is yes. Perfect. You got 2 W-2s you can send me. Now I can look back and see that you had that job for the last 2 years. And if you have job changes, that's okay. Like I said, as long as you have the history. The only thing that we can't do is if you go from, let's say, W-2 and then you go from self-employed, okay? Or you go from W-2 to commission, right? Because commission, we need to see at least 2 years of commission history to average those last 2 years out to make sure that we can actually get a number that we can justify to use to qualify you for the mortgage. All right. Next thing is debt to income. We want to make sure that you don't have a whole lot of debt against you. So think of student loans, credit card debt. If you have maybe some IRS debt, maybe you have collections, maybe you have a boat, I don't know, whatever is on your credit report, whatever you bought with credit or is being held against you on your credit report, that's all going to factor in your debt to income. So we want to make sure that your debt to income ratio is low enough when you go and get yourself pre-approved to get approved for the mortgage, right? So even if you're not low enough, we can quickly see what you'll need to pay off if you have multiple credit cards. We can tell you, hey, you got to pay off your American Express, your Discover card, and you got to maybe pay that student loan off. Once you pay those things off, then your debt to income ratio will be at a point where it's qualifiable. That way we can give you the mortgage. Make sense? All right. So think like a lender when you're going into that process of buying a home. Okay. Now let's talk about your credit. What is the FICO score? It's called Fair, Isaac and Company, right? So that's the most popular score around. It's basically a 3-digit numerical evaluation ranging from 350 to 850, and it's assessing your credit worthiness, okay? So it's based on credit history and current credit amounts. And the score, along with your existing debt to income and employment status, is a factor for your mortgage approval. So all those things count when you're buying a house. So we want to make sure all those things are in order when you go in with your loan officer, do an application to get pre-approved. But first, let's talk about what actually makes up the FICO score. So 10% is going to be new credit. So new credit, like opening up a new credit card. Types of credit is another 10%. So maybe it's a car loan, maybe it's a credit card loan, maybe it's a mortgage, maybe it's student loans, installment debt or revolving debt. That's all going to be in your credit mix, and that's what's giving you 10% of your FICO score. Length of history. So 15% of your FICO score is based on the length of history of how long you've had those credit lines open. So one thing I recommend when you're actually thinking of buying a house is don't close any credit cards. If you have a long-standing credit card from high school or college, you're going to want to keep those open as long as they're in good standing. Keep those open. Make sure they're current. Make sure you pay your debt on time or your payments on time. That way you can create a better FICO score the longer you have it open, right? So don't close any of those old accounts out. The amounts owed, 30% of your FICO score is based on the amounts owed. So on a credit card, a good rule of thumb is make sure you have at least 30% credit utilization. So if you have $1,000 credit limit, you want to have maybe a $300 credit on there, or if you want to be using $300 worth of that, because that's a 30% credit utilization. So I would recommend, don't go past that. And if you do go below it, that's fine. Pay it off if you need to. But typically a 30% credit utilization is where there's that sweet spot that's going to give you the best chance to get a higher FICO score. And then payment history is the last one, 35%. You want to make sure that you pay your bills on time. No ifs, ands, or buts. Pay your bills on time. If you spend money on your credit card, you pay it off that month. Don't rack up a bunch of credit card debt that you can't pay over time, because 35% of your FICO score is based on payment history, on-time payments. So get those payments paid on time, and you'll be good to go. Okay. Here is the ranges of credit scores that are going to be most important to you. If you have a 740 or higher credit score when you're going into buying a home, that's going to give you the best chance for the best interest rate. Okay, 740 or higher, you're going to get the most excellent credit that you can get from a mortgage, right? The best rates, I should say. All right, so like I said, pay your bills on time. Don't apply for too many credit lines when you're actually going into a mortgage, when you're actually trying to get pre-approved. Don't max out your cards, and keep old credit lines open like I shared, okay? So 740 or higher, that's the number you want to shoot for. Okay, and then one thing also that I want to recommend too is just make sure that you keep an eye on your credit report. You can actually get a free credit report every year from, I believe it's checkmycreditscore.com or something like that. Let me double check that. What is it called? It is Check My Credit Score. Let me try to find it real quick here for you. Can't find it real quick. 1 second. Let me pull this up for you guys. It's called credit. 1 second here. Credit score yearly free. Here we go. Annualcreditreport.com. So you can go to annualcreditreport.com, get your free credit report every year, and you want to monitor that. Make sure that you have no abnormalities on there. Make sure no one's using your credit or using your identity, because some people do steal people's mail and go open up credit cards in their name. So you want to check on that. And it looks like here 1 in 5 Americans find errors on their credit report. If you do find errors, call that creditor and get that sorted right away. Okay, so going back to the monthly survival number, this is super important. Most people that I know don't budget at all, right? So if you're buying a house, I recommend 6 to 12 months before going into buying a house, you find out where your MSN is. What is your monthly survival number, or what is the amount of money that you need to survive for 6 months or 12 months, right? So here's how you're going to do it. You're going to take all of your expenses, you're going to list them out, just like it shows here on the screen here. You're going to list them out, you're going to add all those up and then times them by 6, okay? When you times it by 6, you're basically saying, this is the amount of money that I would need for 6 months if I lost my job, if I had no more money coming in, if there was, another pandemic, if there was if I lost my job, whatever it is, now, once you have that number in the bank sitting there ready for you as your emergency fund, now you know for sure if anything was to happen, you got your monthly survival number ready to go in the bank, just waiting for you. You're going to be so much more at ease, going to sleep so much better, because now you have a fallback plan. You have that emergency funding ready to go. Like I said, 6 months if you're single, 12 months if you have a family. Okay. So now let's talk about what you're going to need for your cash. All right. Because after you have that 6 to 12 months in your bank, you're going to have to come to the table with some cheddar. You're going to have to put some skin in the game if you're going to want to buy a house. Some programs actually don't require down payment. However, there are what's called closing costs when you buy a house. So we're going to talk about that. Okay. So on a conventional loan, which is the most popular loan that people get when buying their first home, the minimum down payment is 3% on those. Okay. You're going to have a maximum loan amount. It could vary next year based on the max loan limits, but right now it's $647,200. In high cost areas, it's much higher than that. Like here in Washington, Seattle, I believe it's around $1 million, just under $1 million. So talk with your loan officer. They'll tell you exactly what your max loan amount is. If you are needing to, get some money for your closing costs, you have the ability to get gift funds from a family member. They can cover all the funds that you would need for your closing costs if that was an option for you. Okay. The next type of program that you can have or you can get access to, for whatever reason, the conventional loan doesn't work out for you. These are things like the FHA loan, the VA loan, or USDA loan. That's a 0 to 3.5% down payment. The max loan amount will vary depending on your county. And again, you can use gift funds for your closing costs. Jumbo, this is for loan amounts greater than the max loan amount in your county, 5% down for that. Maximum loan amount, typically $5 million. And again, 100% of funds needed for your down payment and closing costs can be gifts. Okay. So let's talk about now let's go through the CCM tip. While calculating your down payment, remember to include closing costs. They can add up to thousands of dollars, typically 2 to 5% of the purchase price of your home. So like I said, once you know what program you're going to be in, you're going to need to know how much money you're going to have based on the down payment requirements, anywhere from 0 to 5%. But there are closing costs associated with every loan. Again, depending on the type of loan that you have, depending on the circumstance, it could range from 2 to 5%. And those closing costs include things like counter recording fees, underwriting fees, origination fees, and other costs associated with the loan based on the type of program that you're getting. Okay, so just factor that in there, like I said. And all this, again, 2 to 5% can come as a gift from a family member. And by the way, you can get the seller to pay these costs as well. Just ask your real estate agent about that. All right, closing cost expenses. I just kind of went over this. So The home inspection, that's going to be anywhere from $300 to $1,000. Your appraisal, $350 to $550, which is going to give you the value of the house. Homeowners insurance, $600 to $1,800. You have to pay for a full year up front, which is why it's considered a closing cost. The lender fees can be anywhere from $1,000 to $1,500. Title and escrow, counter recording fees, transfer taxes, anywhere from $25 to $37.50, and then transfer taxes $750 for every $1,000. Okay, so there you have it with the closing costs for the breakdown. Now let's talk about your income. So, like I talked about in the past, in the beginning of this, we want to make sure that you have a stable income history. So don't be jumping around jobs if you're going into a mortgage, right? If you're going to get pre-approved, don't change jobs. That's the last thing you want to do. If you do have a, let's say, offer letter in hand, that's going to be okay. We know exactly what you're going to get paid. We know when the start date is going to be. Something like that is a case-by-case basis. So just talk with your lender. Make sure that they know what's happening. Don't keep them in the dark. The last thing you want to do is get all the way to the closing table, change jobs, and maybe it's a different type of income. Maybe you went from W-2 to 1099 and you get yourself disqualified. That would not be good. That would be horrible, horrible, horrible. You don't want to do that. So just keep your loan officer in the know about everything that's happening with your financial profile, because that is all going to factor in for your approval on the mortgage. Okay, so we're just looking for consistency. It can be 2 years in a job, it can be 2 years in a business, it can be 2 years doing Lyft, Uber, whatever. We want to make sure that consistency is there. We want to make sure that you're, paying taxes on that. So if you are self-employed, we'll ask for things like self-employed tax returns or business tax returns. If you're just W-2, we're just looking at W-2s and pay stubs. Okay, so that is a little bit on the income. Now, the debt to income. So again, this is the ratio of your monthly debt against your income. Typically, the lower your debt to income ratio, the more financing options that you have. Okay, so I'm going to pass through this here. Again, this is another CCM tip. Keep your debt to income ratio low. It's going to help you get the home that you want. Okay, because you're not going to have as much debt. You're going to be able to qualify for more mortgage or more home. Right, so pay off your debt when you get it. Avoid taking on more debt, and recalculate your debt to income ratio as you go. That way, you kind of have a good idea of kind of what your debt to income ratio is going into a mortgage. And we'll tell you real quickly again if you're qualified or not, and what you would need to pay off to get yourself qualified if you're trying to get a home. Okay, so let's talk about what actually makes up your monthly payment. So most people think you need 20% down. That's a fallacy. You don't need 20% down on a home. You need, again, 3 to 5% down on a home. And basically what the mortgage is, you're making payments based on your interest rate with whatever you're being lent, right? So that interest rate is determining your principal and interest payment, right? And there's also going to be taxes on the home that you're going to have to pay, homeowners insurance you're going to have to pay, and depending on if you put 20% or less down, you may have to get mortgage insurance. So mortgage insurance is an additional cost on your monthly payment that this is where most people get hung up on. They say, oh, I need 20% down, so I don't pay mortgage insurance. Most people don't have 20% down, but if you do, you don't have to pay mortgage insurance. So just keep those things in mind. 3 to 5% is going to be what you're going to be needing for a down payment. You're going to have to pay mortgage insurance in most cases. There are some tricks to the trade. If you call me, I'd be your loan officer. I can tell you how to get rid of your mortgage insurance. It's not always the case to not have to pay mortgage insurance if you're putting less than 20% down, but it's an option. So those are what goes into the actual payment: your principal, your interest, taxes, insurance, mortgage insurance. And if you have an HOA, like homeowners association dues, like I have one on my townhouse, it's $100. That would be tacked onto your payment as well. It's not going to show up on your mortgage statement. It will show up on our end because we need to make sure that your debt to income ratio is still going to qualify you for the type of mortgage that you're getting. So we have to include it when we're doing our calculations. It's not going to show up on your actual mortgage statement. It's going to be paid to your actual homeowners association privately, however you guys do that. Okay. So that's what makes up your mortgage payment. And now we're going to talk about the home buyer roadmap. So it can seem pretty complex. It can seem like there's a lot to it. But, if you talk to someone like me, someone who makes it simple, someone who takes you through the process from A to Z, you're not going to have an issue buying your first home. It's actually very, very fun knowing that you have, the money to do it. Number one, if you have the money to do it and you have the credit to do it, all you have to do is speak with the loan officer. You ask them how much you're approved up to, and you figure out what you can afford monthly. Again, you don't want to go overboard. You don't want to be paying too much every month, not have any money left over for your groceries. So talking with the loan officer, they're really just going to break it down for you, and they're going to do it in the most simple terms. What I like to say, I like to ask, what can you afford every month? And what do you have available for your down payment and closing costs? Right now we have a way to navigate the amount of loan that we can get you and the purchase price that you can actually go out and seek. Okay, so what most people do though, they'll get super excited. They'll go look at homes that are way over budget. They'll come to the loan officer and say, "Hey, I saw this house for $600,000." We show them a payment, and they're not too happy with that $600,000 payment. They're more happy with maybe a $500,000 payment. So that's why when you speak with your real estate agent, they're going to say, "Go get yourself pre-approved." That way, you know exactly what you're pre-approved up to, and you know how much of a loan you want to take out to make sure that you're comfortable with that monthly payment. So you're going to talk with your loan officer about all those things when you get yourself pre-approved. Okay. Now, the team members that you're going to be, interacting with when you're going through the home buying process is going to be, again, that loan officer. I'm going to be a loan officer. I'm going to be talking with you every single moment of the transaction. Well, not every moment, but throughout the transaction, and giving you advice, giving you just, an understanding of what's happening. You're going to have the real estate agent. They're the ones who are going to help you. We'll make offers on homes. They're going to be opening doors for you. They're going to be showing you homes. They're going to tell you, hey, this house has a HOA, a homeowners association due. This one has a special assessment. This one went off the market, came back on the market. This one just had a price drop. This one, I think we can get $30,000 off. These are all things that are going to be really, really important to you as the buyer, because they are the professional. They are the ones getting paid not by you, but by the seller of the home, and they're making your dreams a reality. Okay, so they have the best interest to making sure that you get the best deal, and they negotiate the best price for you, right? So at the end of the day, they want to make sure that you get the best terms on the contract, best price on the home, and the best ability to get the home in the first place, right? They want to make you look good. So myself and the real estate agent, whoever you're working with, they're going to be working very closely hand in hand, making sure that your financing is in order. And then we make sure that listing agent who's selling the house for their client is completely confident that if they chose your offer, they would have no issues with the loan closing, right? You're going to be dealing with an appraiser. So the appraiser is going to go out there and check the value of the home. Sometimes there's going to be attorneys involved with escrow, writing up whatever they need to write up. Title company, they're making sure that the title of the home is clear, making sure you're not going into a home and, just making sure that it's your home when you buy it. The home inspector, they're going to make sure that there's no problems or issues with the home. And then homeowner insurance agent, that's going to be the person you're going to be, getting your homeowner insurance from. All right. So that's basically your team when you're buying a house. And if you have any questions with any of those things, just ask your real estate agent or loan officer along the way. They will make sure to tell you exactly who to reach out to and why you need to reach out to those folks throughout the process. Okay. So like I said, 6 to 12 months before you intend to make a purchase, I would recommend you meet with a lender, meet with your local lender or a bank. I wouldn't recommend going to a bank because banks don't focus only on lending. They focus on checking accounts, savings accounts, car loans, student loans. There's a lot of things that banks do that aren't specific to only mortgage. A private lender like myself, a loan officer like myself, we're going to work Monday through Sunday. We're going to be available in the mornings and in the evenings to answer your questions, text you when you have questions, email you different scenarios. I would recommend highly going with a local lender in your area and maybe interviewing a couple, see who you like working with. Some I'll say this right now, all lenders are not built the same. Lenders are going to be a little bit different from, some of them like to teach you education on the process. Some like only numbers. Some don't know what they're talking about. So just make sure you maybe speak with your real estate agent, see if they have any recommendations, or if you're finding somebody online, look them up, see what the reviews are, look what other people have said about them. That's usually a good indication that they know what they're doing. Okay. But 6 to 12 months, you want to make sure you speak to a loan officer prior to buying your home. Okay. All right, so now let's talk about what is a pre-qualification versus a pre-approval. So a pre-qualification is simply a calculation of the amount of home that you can afford. It's based on information that you provide with little or no supporting documentation to fully assess your financial stability. Okay, so I have a lot of people that come to me and they say, "Oh yeah, I make $100,000 a year." When I get their W-2s, they only make 8. Right? You want to make sure you get pre-approved so that you don't run into the issue of getting a pre-qualification letter from a lender. They say, "Oh yeah, you're pre-qualified for $500,000." You get under contract in a home, you get to the closing table, and the underwriter's looking at your file, and they say, "Wait a minute, you only make $80,000 a year. That's not enough income to support the payment that you guys would incur if we were to give you this loan." So you're denied. Right? So you don't want that to happen, because now you wasted everybody's time. You don't get the home that you wanted. You wasted money because you're paying for the appraisal. Maybe you're paying for a credit report. Maybe there's other costs included, maybe like a home inspection, whatever it is. You wasted all that money and time. The best thing that you can do is not just get yourself pre-qualified, but get yourself pre-approved with a lender. Okay? Pre-approval means you're sending in your W-2s, you're sending your your pay stubs, you're sending in bank statements, literally qualifying yourself to that lender and saying, "I'm good for what I say I'm good for." Right? You're proving it to them. Right? So once a lender like myself sees all that information, we're going to send out that pre-approval letter, and that's like your golden ticket. That way you can go to homes with your real estate agent and start making offers on places. Right? So that's what you want with the pre-approval. The other thing that the pre-approval does, it determines your actual budget. So like I said, if you want that $500,000 house, that's fine, but you just need to make sure that you're comfortable with the payment, because everybody's scenario is going to be a little bit different based on their credit, based on the amount of down payment they have, based on the type of program they have. It's all going to be a little bit different, again, based on the home even that you are looking at. So you want to make sure that you know how much you don't want to go over. So if your budget's like $2,000 a month or $2,500 a month for your max monthly payment, you tell your lender that and say, "Hey, I want a pre-approval amount based on my comfortability with the payment." Okay. You also, if you say that if the lender says that you're pre-qualified for, let's say, $300,000, and you're like, I don't think I get approved for more. Well, you can actually get yourself pre-approved and then have your lender give you the yes or the no if you're pre-approved for more, right? You don't want to just take it for what they say based on what you're saying, what your situation is. You want to actually go through the process. That way you know your max buying power, okay? The other thing that pre-approval does, it avoids your setback. So, let's say you have a credit score that's not qualifying you for the mortgage that you want. Your loan officer is going to tell you, "Hey, this is what you're going to need to do, and this is how much time you're going to need to wait to actually get your score up to be able to get yourself approved." So it's going to avoid those setbacks, and you're going to save time when you actually are ready to buy the house. All right. So those are the positives of the pre-approval. Like I said, you're going to want to get these things ready. For the pre-approval, you want 30 days of pay stubs, most recent. You want your tax returns, the last 2 years if you're self-employed or you own a business. You want to provide at least 2 months of bank statements to show that you have the money for your down payment and closing cost. Copy of your photo ID. And then we're going to check your credit as a lender. We're going to look at all 3 bureaus, Equifax, Experian, and TransUnion, to make sure that your credit score is in a place that we can get you approved for a mortgage. Okay. So let's talk now about the home buyer roadmap. So first of all, you're going to want to, again, speak with the lender, get yourself pre-approved, and then you're going to want to speak with a real estate agent to go look for that perfect home before you actually put the offer on the home. So they're going to talk about, cosmetic fixes, structural issues, property taxes, neighborhood crime rates, quality of the schools, proximity to major interstates, public transportation. They're kind of like the person who's holding your hand and taking you around different neighborhoods and just giving you a understanding of what you could walk yourself into if you're to buy that particular home. Okay. Your agent's also going to know what are other homes going for, what are they selling for in the neighborhood, and they're going to fight for you for the fairest price. They're going to make sure that the inspection is good for you and good for the amount of work that you want to put into the home. They're going to make sure that there's no plumbing, heating, structural, cooling issues or electrical issues. And if there's anything that you want to be included with the sale, they're going to be able to negotiate that for you. Maybe the seller is thinking about taking the washer and dryer or the TV or something. You would say, hey, I want those things in the house if I buy this place. They're going to negotiate that in there for you. Okay. Okay, so again, you're going to want to apply for the mortgage. So your application will provide us with any remaining financial information we need and lock your interest rate until the closing date. So this is very important. When you find a home, let's say you're pre-approved for $500,000, you make an offer on a house. You're going to take that offer once it's signed by you and the seller. You're going to bring it back to the lender, and the lender is going to lock in your interest rate. So the interest rate is not a locked-in thing until you get under contract. It's actually changing every single day. But as a good loan officer, we're going to tell you, hey, this is actually a good time in the market to lock your rate because it's a little bit cheaper, or it's a bad time because it's a little more expensive. So we can definitely get your interest rate about where we had pre-qualified you and pre-approved you for. But if there is major shifts in the market, there's nothing really we can do to lock in that interest rate until you're under contract. So as soon as you get under contract, let your lender know. They can make sure they get you the rate that you want. Okay. Let's talk about some do's and don'ts as well. When you're buying a home, you want to inform us of any employment changes or compensation changes that are happening. Again, this is super important because if anything changes in the way that you make income or how much you make, it could affect your eligibility and affect you getting the house. If you're moving away from a home and or you're selling a home, you want to continue to make sure that your rent's paid on time, your mortgage is paid on time, and your credit cards are all paid on time. Just don't do anything out of the ordinary until the house closes, right? I want to make sure that there's no challenges or issues going through that process. You want to keep a paper trail of funds moving from accounts. So if you have multiple business accounts or checking accounts, savings accounts, make sure you keep a paper trail of those, or at least have access to those, so that if the underwriter asks for those documents, you can get those easily. Again, notify us on any changes in your finances. Notify us as well if you have any travel plans, so we can assist for the closing of your home. Sometimes you may need to do a work trip and you can't sign documents. We may need to arrange a notary to go to where you're at to sign those documents. Okay. Don't change or quit your job. Don't co-sign for anybody. Don't transition from employed to self-employed. Don't close out any credit cards. Don't max any credit cards out, and don't move funds from accounts to accounts. Because it's all going to require a paper trail. So those are the do's and don'ts when you're going through the home buying process and going through get yourself pre-approved. All right, so underwriting and appraisal. So what is underwriting? So like I said, I'm going to be that lender throughout the process, helping you get financing. I'm also kind of like a lawyer, proving your case to the judge. And the judge in this case is going to be the underwriters, right? So if you have a complex situation, I want to make sure I have everything down in a story so I know, hey, this is what happened throughout the last 2 years. We can see that you have a continuity of income. We can see it through your pay stubs, your W-2s. We can see it through maybe some unemployment that you took. We know that you've been receiving income for the last 2 years. This is why you're good for the money that we're going to give you. Here's my package to you, Mr. Underwriter or Mrs. Underwriter. Please give us an approval. So that's basically what underwriting is there for, is to basically double check our work, check the guidelines that we're check the guidelines that we're approving you for on that particular loan program. Make sure that I did my job right, and make sure that we can have a sellable loan, because as a lender, as a loan company, we actually don't keep the loans ourselves. We sell them and they get packaged up on the secondary market and traded in the bond market. Okay. So within 48 hours, an underwriter will typically review your loan application. We're going to ask for any conditions, or at least they'll ask for some conditions. So if I missed anything or they want clarification on something, they're going to make it a condition before closing. So we'll definitely let you know throughout the process what those conditions are. And then once we have those conditions, we'll send it back to the underwriter for CTC, which is known as clear to close. That's what you want to hear, the CTC. That way we can send your documents to title and escrow. They can start getting all of the documents ready for you to go and sign. And once you sign, get your house recorded with the county to show with the county that it's actually your home now. Once that's done, you are going to schedule closing with escrow. You're going to go and basically sign a stack of papers about that thick. And once you sign those papers, you're going to officially be a homeowner. Once it records with the county, the real estate agent that you're working with can now give you the keys to the home. And now you can start preparing to move in. That's what it's all about, baby. Moving into the new house. So you want to make sure that you arrive to that appointment ready to review those final documents. You want to bring a cashier's check, okay? Cashier's check is going to be what funds you'll need for the house, right? So if you needed 3 or 5% down payment plus whatever closing costs, that's when you're going to give the money to the title company or escrow company. That way, we're not getting it directly as the lender. We have to do it through an intermediary, which is escrow. They're going to collect the money. They're going to let us know that the money has come in. And once all that is set and ready to go, bada bing, bada boom, it records with county and you get your keys. So that is closing. Now let's talk about the differences between a home inspection and home appraisal. Okay. So the home inspection, that's going to determine the condition of the property. Okay. You get that once you have the offer accepted, right? So you want to make sure that there's nothing wrong with the home, because if there is, your real estate agent, depending on how they write the contract, if there's an inspection contingency, you don't like something on the house, you can back out and say, hey, I'm only into this house for $400 because that's how much the inspection cost. So it's actually a good thing to get the inspection, because now you're not getting yourself locked in to something that you don't want to buy, right? Because if it has a $20,000 roof that needs to be repaired, you don't want to be spending $20,000 right when you walk in, because you just spent a bunch of money with the down payment and closing costs, right? So home inspection is there to protect you. The home appraisal, that's going to determine the home value, right? We're also going to order that once your home, or we'll order an appraisal when your loan goes to underwriting. For us, typically we order that a little bit earlier before it goes to underwriting, because we want to make sure that, the value of the house is there for us to be able to give you the loan in the first place. And that usually ranges from $400 to $600. Okay. And that is it, guys. That is the home buying process in a nutshell. If you do have any questions, please leave them down below in the comments. Like I said, if I can get back to them, I will. I'm going to try to do my best to get back to all of them. Hope this was helpful, guys. Take care. I'll talk to you soon.